The world doesn't move evenly. It shakes. And right now, the global economy is shaking again in a way that almost nobody can ignore. Oil has suddenly jumped 6%, and the number that once terrified markets, $100 per barrel, is once again being whispered across trading floors, newsrooms, and government offices. But here's the real question nobody is answering clearly. Why now? Why again? And what does this mean for every single person watching this, from New York to London, from Dubai to Karachi, from Beijing to small towns where fuel prices decide daily life? Because this is not just about oil, it is about power. It is about inflation. It is about wars, politics, supply chains, and the invisible system that quietly controls how expensive your life becomes. And what's coming next might not just affect markets. It could reshape the global economy all over again. To understand this moment, you don't start with numbers. You start with pressure. Pressure that has been building under the surface for months. Global oil markets had been relatively calm compared to the chaos of previous years. But that calm was never stability. It was tension waiting for a trigger. And that trigger has arrived. A combination of supply concerns, geopolitical friction, production expectations, and shifting demand forecasts has pushed traders into a familiar emotional state. Fear of shortage. And in oil markets, fear is not emotional. It is financial. It moves billions within minutes. When traders believe supply might tighten even slightly, they don't wait for confirmation. They act first, ask later. That is how a 6% jump happens almost overnight. But what makes this moment different is not just the rise, it is the direction it points toward. The psychological barrier of $100 per barrel is not just a price level, it is a global economic threshold. Below it, economies breathe. Above it, economies start to strain. Transportation costs rise, manufacturing gets more expensive, food prices feel pressure, inflation returns like an old problem that never truly disappeared. And the world has seen this before. Every major spike in oil has left a footprint on history. Recessions, political shifts, public unrest, policy changes. Oil is never just oil. It is leverage. It is influence. It is a silent tax on the global population. And now, once again, the question is whether we are standing at the beginning of another cycle. To understand why prices move like this, you have to look at the invisible architecture behind the market. Oil is not priced in isolation. It is shaped by expectations. If traders believe supply will tighten in the future, they price it today. If they believe demand will surge, they adjust instantly. And if they fear instability in key producing regions, they react before anything physically changes. This is what makes oil different from most commodities. It is not just about barrels in tanks. It is about belief. And right now, belief is shifting. Major producing nations are navigating a delicate balance between controlling output and maintaining revenue. Any hint of production cuts, voluntary or strategic, immediately sends signals through global markets. At the same time, demand projections are adjusting. Some regions show slowing industrial activity, while others continue expanding consumption driven by transportation and economic recovery patterns. But the real tension comes from uncertainty, because markets hate uncertainty more than bad news, and uncertainty is exactly what is driving this 6% spike. Geopolitical risks remain one of the most powerful forces in energy pricing. Even rumors of disruption in key shipping routes or production zones can trigger immediate reactions. Traders do not wait for confirmation because in oil markets, waiting can be expensive. So they move early, sometimes too early, but often just in time to profit from fear. And that fear spreads quickly. Once prices start rising, algorithms, hedge funds, and institutional investors amplify the movement. What begins as a fundamental concern becomes a momentum-driven surge. This is why oil spikes rarely move in small steps. They jump. And once they jump, the world starts paying attention, because the consequences are immediate and visible. Fuel stations adjust prices, airlines revise ticket costs, shipping companies recalculate freight, manufacturers prepare for higher input costs, and consumers, the final link in the chain, begin to feel it everywhere. But beyond economics, there is something deeper happening here. Oil price movements often signal shifts in global power dynamics. When oil rises sharply, exporting nations gain leverage. Their revenues increase, their budgets expand, their geopolitical influence strengthens. At the same time, importing nations face pressure. Their currencies weaken under import costs, their inflation rises, and their policy decisions become more complicated. This imbalance is not new. It has shaped international relations for decades, and every time oil crosses critical thresholds, negotiations behind closed doors become more intense than what is shown in public headlines. Because energy is not just a market, it is strategy. Now, the return of the $100 narrative carries emotional weight in global markets because it represents memory. Traders remember past cycles when oil at this level triggered inflation shocks, interest rate hikes, and economic slowdown fears. Central banks remember it too, because rising energy costs often force difficult decisions, tighten monetary policy, or risk inflation spiraling further. Neither option is easy, and both come with consequences. But what makes this moment even more sensitive is timing. The global economy is still navigating post-inflation adjustments, debt pressures, and uneven recovery patterns across regions. Many economies have only recently started stabilizing price levels after years of volatility. A sudden energy shock disrupts that fragile balance. It forces a recalibration, and recalibration is never smooth. Markets don't just react to current price changes, they price in the future. So when oil rises 6%, analysts immediately begin revising forecasts. Inflation expectations shift, growth projections adjust, corporate earnings models are reevaluated. In other words, one movement in oil creates a chain reaction across the entire financial ecosystem. But here's what most people miss. Oil spikes are not just economic events. They are psychological events. They influence how businesses plan, how governments respond, and how individuals feel about the future. When energy becomes expensive, everything feels uncertain. And uncertainty is the most expensive commodity of all because it slows investment, delays expansion, and increases caution across all sectors. This is why even a short-term spike in oil can have long-term effects that outlast the price movement itself. Now, the critical question becomes whether this is a temporary reaction or the beginning of a larger trend. Markets are currently divided. Some analysts see this as a supply-driven spike that may stabilize if production adjusts or if geopolitical tensions ease. Others believe this is the early phase of a broader uptrend driven by structural demand and constrained supply capacity. Both views carry weight, but markets don't wait for clarity. They trade on probability. And right now, probability is leaning toward volatility because every factor that influences oil is currently active at the same time. Supply uncertainty, demand shifts, geopolitical tension, currency fluctuations, and speculative momentum. When all these align, price movements accelerate. And that acceleration is exactly what we are seeing. But beyond charts and forecasts, there is a simple reality that connects everything. When oil rises, life becomes more expensive. Not instantly for everyone, but gradually and everywhere. It starts with transport, then goods, then services, then inflation data, then policy response. And finally, the global economy adjusts again to a new baseline. This cycle has repeated many times in history, and every time it leaves behind winners and losers. Energy producers often benefit. Energy importers struggle. Consumers feel the pressure, and policymakers are forced to act. But the deeper impact is always about stability, because stable energy prices create stable economies, and unstable energy prices create uncertainty in everything from groceries to global trade. And that is why this 6% jump matters far beyond trading floors. It is not just a number on a screen. It is a signal that the global system is once again entering a phase where energy will be at the center of attention. And when oil takes center stage, everything else moves with it. The only question now is how far this move will go, and whether $100 is just a psychological milestone or the beginning of a new economic reality the world is not fully prepared for yet. And the answer to that depends on what happens next in the shadows of global supply, political decisions, and market psychology that most people never see, but everyone eventually pays for.